Hello, everyone. What if I give you the best financial plan of your life, a 20-year simple strategy to make you financially secure and stable for long term? It's a simple strategy that we are going to look into and how the simple strategy is going to transform your financial life. First is to secure your life with term insurance. Ensure that your family stability is focused with term insurance coverage. We need to prioritize family protection as the financial foundation. This is essential because for any financial plan without insurance, investments are vulnerable and all my wealth plans can collapse under any unforeseen risk. And that is why securing your family with term insurance is equally important. You need to buy a term plan covering 1.5 to 2 crores of the total value. Choose a term insurance plan that covers 15 to 20 times of your annual income, ensuring that you have sufficient financial backup for your family. Also, once you're doing term insurance, add only critical illness and accident disability riders. This will enhance your term plan in case of any critical illness and disability related to any accident. This will the additional risk without overcomplicating your policy. You should add nothing more than that because that will increase the premium of the term plan. Avoid plans like money back or whole life policies. These are policies which will charge you more premium and will give you less value. Ensure that your coverage will last at least until the age of 60 or 65. That is your working life. Coverage should extend throughout your working years rather than lifetime policies that may not be necessary. Also, term insurance is a financial safety net. From leadership perspective, term insurance secures a family stability. During worst case scenarios, you need to focus on adequate coverage over expensive or complex policies. The next important aspect is to protect health with family health insurance. You need to shield your finances from unexpected medical expenses. We need to understand the impact of medical expenses on savings. Any medical expenditure can wipe out years of savings if not adequately covered. This makes health insurance essential to protect your financial future. You can choose an affordable family floater plan. This plan covers the entire family with coverage between 10 to 20 lakhs based on what you can afford as premium. Pick plans with fewer conditions and high claim flexibility. Opt for policies that have low restrictions and allow easier claims to avoid hassle during emergencies. You should prefer cashless hospitalization at reputable hospitals. Choose health insurance that offers cashless treatment options at well-known hospitals to reduce out-of-pocket expenses and simplify the process. Again, you need to recognize health insurance as a financial safeguard. It will protect your overall financial plan by preventing unexpected medical costs from eroding your wealth building efforts. The first was term insurance. The second is health insurance. The third is to plan for your retirement and planning it early. There are different retirement options available in the market. You need to start early to leverage compounding and secure your financial independence. Now, retirement is a long-term financial goal. The earlier you start, the better you would be able to leverage the power of compounding for good returns. You can open an NPS account, which is new pension scheme. Under NPS, as a disciplined retirement saving vehicle, you can build your corpus steadily. You can also use online retirement calculators to estimate your monthly contributions needed to meet retirement goals. You need to begin monthly investing immediately. Start with even small amounts to build habit and benefit from early investing. You have to maintain consistent contributions without withdrawing early. at any cost. Early commitment reduces financial burden in the future. It is especially important for young professionals to ensure independence and peace of mind for your future. Now, the fourth is to secure your children's future. You need to start with small investments early for your children. Beginning small investments early helps to reduce future financial pressure related to children's education and life goals. If you have a daughter under 10, you can invest for Sukanya Samriddhi Yojana. You can also encourage PF or PPF contribution for your son. Avoid costly child plans with poor returns, normally what you get in the market. Prioritize government-backed or proven instruments to give your children a good future. A cost that would require for other education and marriage as well. The fifth is to build emergency fund. Create a reliable backup to protect your finances from unexpected shocks. Maintain an emergency fund covering at least minimum 6 months of expenses. This should be enough to cover half a year household cost. To handle unforeseen financial challenges without stress, you need to keep funds in an auto sweep account or liquid mutual fund. These accounts or funds are highly liquid and flexible. Your emergency fund is always available with you whenever you need it. You replenish the emergency fund immediately after withdrawal. So let's suppose you have an emergency fund and because of some reason you had to withdraw it. You have to ensure that you put back the money as early as possible to maintain continuous financial protection. The emergency fund will act as a liquidity buffer for you. It will protect your long-term financial plan for unexpected shocks by having a reliable safety net in place. Now, the sixth important aspect is to invest for long-term goals. Now, building wealth is a long-term process. You would definitely have long-term goals which expand over 10 to 20 years. You can use SIP and index funds for goals beyond 7 years. Why? Because the index funds are safe and go along with the market index. You can add one or two active mutual funds for extra potential. Stay consistent. Avoid chasing hot funds or timing the market. Just be invested for a long period of time and you will get the returns which you deserve and want. Also, you can have some amount of gold in your portfolio. This will protect your portfolio from risk and inflation shocks. And gold protects against country-specific risk. You can buy gold ETF instead of physical gold. Also, you can allocate 5 to 10% of your portfolio to gold. Use free gold planning calculators to track the allocations. Gold will always diversify your risk and complement your overall portfolio, which includes equity and debt. This is a good safety net for your future. Next is to avoid wealth destroyers and follow the 95% of rule of financial success. So what are the key habits and fundamentals that protect and grow your wealth consistently? Let's talk about how your wealth is lost. Most of the losses of your wealth comes from distraction. So avoid risky trades and speculation. You need to avoid intraday trading, futures, crypto bets, and get rich quick hacks. Uninstall addictive trading apps. Use browsers to reduce the temptation. Focus on proven strategies for steady and safe wealth growth. There's a rule called 95% of rule which says that 95% of success depends upon foundation like insurance and emergency fund. You need to have at any cost insurance, retirement, children plan, emergency fund, SIP and gold. Complete the core steps before advanced or experimental investing. Discipline in fundamental ensures that long-term financial success is guaranteed.